Thank you very much, Ambassador Desker. It's always a pleasure to be back here and to enjoy the luxuries of Singapore, particularly coming from the United States with the financial problems and the economic problems that we're facing. One of the first bits of information I got when I was coming in from the airport was to find out that it costs about $90,000 to get a permit to buy a car that will probably also cost you another $90,000. So Singapore seems to be extremely rich. But I would remind those of you who are feeling particularly flush these days the remarks of John Paul Getty, who said, if you have to count your money and you can still count your money, you're clearly not a billionaire. So for those of you who are checking your wallets, there's still a long way to go. Let me start by summarizing a couple of the things I think are important about the two crises. As Ambassador Desker was mentioning, the financial crisis of 1997-98 really enveloped much of East Asia, leaving it financially and economically devastated for a period of a couple or 3 years. It was, I think, in hindsight, clearly a liquidity crisis, but it found that many of the Asian economic fundamentals remained sound. And importantly, East Asia recovered from the crisis within 2 or 3 years in a kind of snapback recovery. But during the period, much of East Asia was devastated by the crisis. The crisis of 2007-8-9 really saw a sharp downturn within Asia due to the trade contraction globally, but East Asia has recovered quite quickly, and in effect, there was no global protectionism that was put in place the way there was after the 1929-1933 economic crisis. And with free trade remaining in place, East Asia was well positioned to take advantage of continuing its trade activity and has been able to recover quite well. And I think for many, the comparative situation of East Asia, when one looks at North America and Western Europe, suggests to many that East Asia is now really poised to make the 21st century its own. So I want to take us through those crises. And an important book, did I get that right? Yeah, okay, sorry. I keep playing with these slides up until about 5 minutes before we start, and I can never remember the exact order. Some of you may be familiar with the book by Rogan and Reinhardt and Rogoff, essentially saying this time is different. And they trace 8 centuries of financial crises and argue that essentially all of these crises have been the same. There has been a euphoria that has taken place at some period in time over a new discovery. It may be tulip bulbs, it may be the railroad, it may be the telegraph, it may be the .com, et cetera, but each time there's a perception that this time is different. This is not like the other financial crises. This time we are poised for some new miracle discovery and success. And in this regard, it's only with the advantage of hindsight after the bubble collapses that we learn that this time is not really different after all. I want to suggest that the two crises that I've been talking about were in fact fundamentally different. And here I take issue with Reinhardt and Rogoff. They were very similar in many economic respects. A lot of hot money moved in. Global capital was very critical to both crises. They were similar in the fact that at each point, whether we're talking about Asian growth in the 90s, where there was a sense that Asia's future was absolutely unstoppable, only to find that in 97 and 98 it suddenly backfired, or at looking at America's and Western Europe's financial success in 2005-06, with the expectation that finance had found some new way to advance and to continue hyper-growth. And then suddenly, again, we find things very differently collapsing. But importantly, because my checks come from a political science department, I want to suggest that while the economics may be very similar to the two crises in some important respects, the politics was quite different, and it's because of the politics that the two really need to be understood as quite different. A metaphor that I would offer to you is if the economist really wants to focus on how fires are similar and attract attention to oxygen, flame spread, combustible materials, etc., then things look very different. But the political scientist would suggest that it makes a difference whether the fire was started by an electrical short circuit, by lightning, by smoking in bed, lovely picture here for you to remind you, or an arsonist. And in many respects, these two crises were started in very different ways by political machinations. In order to set the tone for the commentary on the two crises, I think it's imperative that we go back to the fact that political deregulation, financial deregulation, had a political base, and financial deregulation became the operative ideological motif within the United States and then importantly in much of Western Europe. Many of you, I think, are probably familiar with the Bretton Woods system, which kept a very tight financial set of regulations and currency controls in place until 1971. The US dollar was dominant. Currencies were largely pegged to the dollar. There was a great deal of predictability in trade and a great deal of monetary regularity in place. 1971, that changed when the United States fiscal policy became completely out of hand as the United States was funding large social welfare improvements under Lyndon Johnson's war on poverty and the war in Vietnam, for which taxes were not going to be raised. Countries became very dubious about the staying power of the US dollar. There was a run on the dollar, and Nixon essentially took the US off Bretton Woods. In the wake of the end of Bretton Woods, countries and the globe at large have tried to figure out how best to regulate monetary policy, and the US and Britain in particular, but followed by a lot of European countries, have moved forward with less and less financial regulations, moved toward greater and greater deregulation. In the United States, as I'm sure many of you are familiar, we ended with the Glass-Steagall Act, ending the Glass-Steagall Act, we ended the differentiation between savings banks or commercial banks and investment banks, and banks and investment companies were free to move back and forth across these different arenas with little or no regulation in place, and things were pushed even forward by the deregulatory mood of over-the-counter derivatives in 2000, including the credit default swaps, which in some respects became at the heart of the 2008-2009 financial crisis. And the goal for many economists and politicians in the United States, in Britain, was what they continually referred to as a self-regulating financial market. In effect, less government, the market itself, will create the environment under which it will regulate itself and provide insulation from any future crises. Into that mix came what you might think of as increasingly complex financial engineering products. Basically, banks and financial institutions put together ever more complicated derivatives, second derivatives of derivatives, currency exchange arrangements, etc., all designed to allow for the highest possible yield in the shortest possible time. The development of high-speed computers and massive movement of information across borders made it possible for investors to target what you might think of as millisecond arbitration opportunities. Slight changes, slight variations in exchange rates between different countries or different currencies could perhaps be captured in less than a second if your computer model was fast enough. And so investors began putting money into ever more complex financial products as financial institutions developed these ever more sophisticated products. And importantly, at least in the United States and to a lesser extent in Britain, finance moved away from being the terrain of economists and MBAs and moving into becoming the terrain of aerospace engineers, mathematical theorists, people in pure physics who could create the pure mathematical models that might be terribly complicated but would allow the financial institution to take advantage of these products. So we had a whole variety of things being put in place, including derivative swaps, et cetera, credit default swaps and the like. Arbitrage opportunities were critical. And importantly, banks and financial institutions began to move toward ever higher levels of leverage using borrowed money. This reminds me of the advice given to someone who wanted to be a successful banker. He asked the banker what he should do to become a successful banker. And he said, I can't tell you what it will take to become a successful banker, but I can tell you 3 things that you should not do if you want to be a successful banker. Never lend money to somebody who doesn't have money. Never lend money to anybody who's desperate to get your money. And third, never lend your own money. And this was very much at the heart of the financial crisis. Nobody was playing with their own money. This is an effort to understand what the so-called quants were, the aerospace engineers, et cetera, who were working behind the scenes in many of these financial institutions. And as a consequence of this change, we saw an increased role for finance and financiers, both within the economy as a whole, but also within the political arena. So there's some data here that shows from 1973 to 1985, the financial sector never counted for more than 16% of domestic corporate profits. 86 was up to 19%. In the 90s, it sort of varied between 21 and 30%. In the 2000s, it reached 41%. And similarly, financial salaries, the salaries of high-level financiers, also escalated very dramatically, jumping to somewhere in the neighborhood of 181% of what you might make as a CEO in a manufacturing firm or something of the sort. So this just shows the rapidly rising trend of the financial industry within the United States. And of course, part of the politics of this became the use by the financial arena of its economic power to shape the political climate. So as things became ever more sophisticated, instruments became more complicated. We saw a big jump in value of these paper value products of about 5 times between 2002 and 2008. These products were becoming ever more sophisticated. They were taking on an ever larger role within the economy as a whole. And these paper products were essentially about 10 times the total GDP of the entire world. So a lot of real paper value moving around. And of course, the phrase that became associated with all of this was that certain firms became too big to fail. No one could let them go down, and to the eyes of many, it was also an arena or a time during which we saw the prevalence of what you might think of as casino capitalism, the betting with other people's money on a variety of financial outcomes. Sorry. Okay. Now, that's sort of the big background on global capital movements. Let me step back to the 1997 period and look at how this interfaced with Asia during the first crisis. I'm sure many of you are familiar with these periods and events, but a couple of things that I want to highlight. Basically, the crisis began in July of 1997 when Thailand revalued its currency, ended the peg between the baht and the dollar after it had exhausted about $26 billion worth of its own foreign reserves, trying to defend the currency from speculators. Within weeks, Indonesia was in a similar situation, Malaysia was under challenge, so was the Philippines. Eventually, South Korea succumbed to a similar currency crisis, and the permutation of these shocks rippled across Asia generally, and also rippled down into the real economies, creating large measures of unemployment, financial collapse by banks and other financial institutions. A lot of small and medium-sized industries went out of business. There were riots in a number of these countries, etc. The situation became quite serious. And basically, you had a situation in which there was a crisis of capital flight, money that had moved in, moved out very quickly, currency depreciations, bank and corporate bankruptcies followed in their wake. And as I said, the crisis rippled across the region. So as one of my colleagues once put it, Asia went very quickly from being a miracle to needing one. And here I want to just remind you or highlight what I think are a couple of important facets of the Asian economic development strategies and why Asia was vulnerable to the crisis in 97-98. Essentially, the Asian countries that were most seriously affected were playing a game that you might think of as national catch-up, technological gap closing, whatever you want to call it, but they were convinced that theories of Ricardo and other free trade economists that talked about comparative advantage would leave countries like East Asia permanently behind the more advanced or sophisticated economies of the rest of the world. So their target was not to play to comparative advantage, but to create competitive advantage. How do we catch up with the West? How do we create advantage for our companies? And they did this largely by investing large amounts of money in increasing the production capabilities of their companies, which tended to reduce the average cost of unit production. Very long-winded economic way of saying, if you made bigger factories, it cost you less to make one car than it would if you were only making 100 a year. If you were making 100,000 a year, it's obviously cheaper. And that would mean that you could sell these overseas. So as long as the overseas markets were receptive to your exports and you could continue to increase production, it seemed to be a very safe model for the future. Except if you got into situations of excessive competition, or if you got into situations where suddenly export markets closed down. And in this regard, the second piece of the model was the close business corporate relationships in all of these countries. So government worked very closely with the corporate sector to try to ensure that markets remained open, that competition did not get out of hand, and so the government had a hand in the economic development in places like Korea, like Indonesia, and like Thailand, although it was quite different in all cases, but it always involved government guarantees of corporate profit and close ties with corporations that were doing what the government wanted. A few facets on the economics of the crisis. Basically, in the early stages of their economic development, most of these countries were using domestic money to invest in domestic production, so that it was kind of a closed loop. The government could retain a lot of control over it. Companies were not as vulnerable. But in the mid-1990s, many of these countries became open to greater foreign direct investment, and because the US dollar was weak, US interest rates were very low, they were very anxious to borrow money from the US, invested in Thailand, or invested in Malaysia, or invested in Indonesia, and to do so in ways that frequently meant very low interest costs borrowing from the US, high rates of return as they lent to locals, but never worrying about currency risk and never hedging against currency risk, so that when the value of the dollar began to change, suddenly borrowers were forced to pay back in the local currencies much larger amounts than they had anticipated, and suddenly it became very sensible for foreigners and lenders to hedge against, to bet against the currencies. So you had the rising dollar, and you were pushing toward the devaluation of the currencies. And meanwhile, Western investors, because Asia was becoming the miracle of the 1990s, began investing almost blindly in Asian economies through stocks, through bonds, through short-term investments in properties, but not so much in long-term FDI or creation of factories, but in things that left their money quite liquid. It looked like guaranteed profit. And the data here just gives you a sense of how quickly the GDPs of these Asian countries became increasingly dependent on foreign capital and its presence within the region. And so the economic crisis created this mood of Asian contagion in the sense that everybody wanted to be in Asia when it was doing well, but it also very quickly created Asian contagion when everybody wanted to get out. As soon as Thailand fell, everybody else's currency was relatively vulnerable. And politically, the governments were facing a difficulty. For the most part, they were so close to business that they had guaranteed profitability for business, guaranteed shares, etc. They could not simply say, you borrowed the money, tough luck, you are out of luck. Basically, they had to make decisions about whether to try to hold on to the peg, protect it with limited foreign reserves, or what to do in the face of massive foreign speculation against their currencies. Ultimately, as international fund managers were selling the local currencies and forcing pressure on the government to put more and more of its foreign reserves into protecting the currency's value, it became very clear that these relatively small economies with relatively limited global resource and foreign reserves could not hold off the global attacks on their currency. So basically, you saw very quickly capital flowing out of the country after it had flowed in so quickly. I'm sure, again, within East Asia, it's very clear that there were two views of the IMF crisis. From the standpoint of the United States or the IMF, the problems of this crisis really were traced to close government-business relationship, moral hazard, crony capitalism, failure to embrace free markets, failure to open up to competition. Basically, Asia failed because they didn't do it our way, and our way was the logical way, the only way that an economist could see of doing this. Whereas within Asia, I know the Koreans talked about the IMF crisis as meaning, I'm fired. And that was pervasive throughout, I think, Asia, the sense that the IMF had basically taken a crisis that was due to liquidity shortages and turned it into a crisis that was going to require a complete rejiggering of the domestic economic development models within the countries. And in the eyes of many within Asia, I think it was seen as a cynical ploy by the West to undercut the Asian development model. The IMF bailouts, of course, were necessary for these countries, but they damaged the real economies because they did not address the liquidity problem. So they exacerbated the cuts in unemployment. They reduced the capacity of the government to bail out poorer citizens. And basically, there was an end to government subsidies for fuel, for food, etc., that left many, many below the poverty line, and that created a huge opportunity for Western investors to move into the economies that were recipients of the IMF bailout. And in one of my favorite quotes that reveals what I think is his true character, Larry Summers, then Assistant Treasury Secretary, said that the IMF crisis in Korea has done more to open up Korea to American investors than 20 years of bilateral negotiations. So from Summers' standpoint, this was a tremendous opportunity for the West to take advantage of Asia, which was now on its knees, to gain leverage in areas like automobiles or insurance or banking, etc. Okay, so summing up, I think fundamentally this was a crisis due to the negative interactions between the domestic, politically driven model of economic development. We want to invest heavily in expanding production, but that makes us vulnerable to foreign money if we borrow too quickly and we don't hedge, on the one hand, versus the power of global capital coming in from the outside, and of course a heavy dose of politics in the nature of the IMF and US support for these countries during the period of crisis. Importantly, as I said, Asia sprung back from the crisis rather effectively. You see here, 97, big drops in the GDP of all of these countries, but by 98 they were starting to be back, and by the year 2000, 2001, they were close to the same trajectory that they had enjoyed before, all suggesting that there was nothing fundamentally wrong with these economies that a little bit more liquidity might not have dealt with. All of these economies came back relatively effectively. Turning from that to the crisis of 2008-9, one version of the story is very straightforward. It was a global macroeconomic explanation. Huge US overspending and undersaving combined with Asia's oversaving and underspending created the conditions for the West to become dependent on Asian money in order to keep its consumption going forward. A couple of graphics that might suggest the validity of this, the US overborrowing and consuming, Asia oversaving and under-consuming. But there's a micro-political explanation that I think is much more critical. And this means going back to that earlier political power of finance that I was suggesting at the very beginning of the talk. Just repeating the numbers, big jump in the rise of finance within the economy of the United States, and an important rise in the political capacity of finance to effect the politics of Washington, D.C. Some of you may be familiar with the comments made by James Carville, political advisor to Bill Clinton, who at one point said, I used to think that, if I came back in reincarnation, I want to come back as a 300 batting average baseball player in the major leagues, or I'd like to come back as the Pope where I can declare things sinful, non-sinful. He said, but now I realize I want to come back as the bond market. There's nothing more powerful than the bond market. The bond market can override politics any day of the week. And in many respects, that became the mindset, I think, within the United States. Deregulation continued, particularly during the Reagan period, and then subsequently during the Clinton years, the Bush years, etc. And we saw a big rise in the class gap within the United States, and what we're still facing now, the erosion of the American middle class. That plays into another piece of the story, which is the U.S. housing market. The Federal Reserve, our setter of interest rates, lowered interest rates dramatically after our dot-com bubble burst in order to re-stimulate the economy. That meant that it became ever more cheaper to get a mortgage for a home. It made borrowing for homes cheaper, and it also meant an opportunity for these new financial wizards to create subprime mortgages, mortgages that would be below average rates of borrowing interest, but to use these as teaser rates for very short periods of time so that people could get into a house for very little money for a short period of time, after which presumably the value of the house would continue to go up and they would be able to refinance. So you had this win-win situation for the banks. They could continue to lend every couple or 3 years to people who were refinancing their homes, and it seemed to be a winning situation for those who were being increasingly cut out of the middle class by allowing them to buy a home and to gain that big piece of the American middle class dream by getting in cheaply and by assuming that their housing prices would continue to go up. The end result of this was that the house in the United States became the equivalent of an ATM. As the value of the house went up, people would draw out money from the house from this new paper value in order to pay their kids' tuition, to buy a yacht, to take a summer vacation, to make up for the fact that their income was not what they had hoped it to be, et cetera, but it looked like it was going to go on forever. Unfortunately, once you have the advantage of hindsight, you can see that the housing prices were completely out of whack with historical reality. I don't usually go back to 1890 for my starting points, but the data on housing prices from 1890 into the 1990s was relatively flat. If you look at it in terms of inflation-adjusted housing prices, or even in nominal housing prices, it's really only in the 50s and 60s that you start to see any increase, and it's really in the 1980s and then with acceleration in the 1990s that these prices go through the roof. And it was this period when my wife and I made the decision to move to Berkeley and found ourselves, for example, in the midst of bidding on houses where a notional price of, let us say, $500,000 for a house would simply be the starting point for bidders coming in and offering $550,000, $580,000, $600,000. It was insane, but nobody thought that housing prices would go down in the short run, which of course is part of the "this time is different" mindset. Housing prices will continue to go up forever, won't they, boys and girls? No. I mentioned teaser rates. Fewer and fewer qualifications were needed to get into a house. One story that was told in one of the financial digests during this time period was of a Las Vegas pole dancer, which I'm sure you don't allow in Singapore, but a pole dancer who is certainly not very well paid, even with tips, had something like 6 or 7 condos that she was furnishing through, creating through these subprime mortgages, and she was making a huge amount of money on paper, even though she had virtually no income that would justify her purchase of these things in the first place. Mortgages, and I will summarize the housing crisis in a second, but the last piece of this that was critical was mortgages had traditionally been offered by banks for a 30-year period, coupled was in to the local bank, takes out a mortgage, they've got a lot of security, the banker stays in touch with them, they pay a monthly fee to fund the mortgage, and the banker knows who they are, they know who the banker is, but by this time, banks were no longer holding mortgages, they were very quickly selling them to what were called bundlers, who would take dozens or hundreds of mortgages, package them into a single security, slice them up into various components that were arranged by our aerospace engineers and our theoretical mathematicians in ways that could then be sold as securities as opposed to mortgages. Investors would buy these securitized home value mortgages, and they would typically receive AAA ratings, the best rating you could get from ratings agency like Fitch, S&P, Moody's, etc. So that, again, there was a structure of, if you want, crony capitalism or corruption built into this, but it was one which seemed to keep everyone in ever-increasing assets moving forward. Last piece of the picture is these credit default swaps. Basically, these were opportunities that were put in place to allow you to buy insurance against the possibility of default on things like securitized mortgages. But you didn't have to own these. You could simply make a bet on these, and when everyone was betting that the housing market was continuing to go up, more and more of these credit default swaps, credit default obligations were issued. Huge amount of paper traffic on this, multiple trillions of dollars were bet on this because it was seemingly profitable, seemingly no way to lose, profitable for speculation as all of these firms began to search for ever higher levels of yield. And the only underlying risk was if the housing market collapsed. So long as housing prices continued to go up, there was no problem. But of course, housing prices did begin to collapse in 2007, and that was the first piece of support that was pulled out of these of the entire financial network that was going before this. The government role through all of this was to create unregulated finance, to move out of regulating finance and to allow financial institutions to do whatever they felt like doing. And in particular, Alan Greenspan, who was the head of the Federal Reserve, essentially socialized risk. He essentially telegraphed the message to the financial institutions that they could continue these practices, none of them would be regulated, and the Fed would allow them to take any profits, but ultimately the Fed would be behind them in the event of failure because they were too big to fail, and he would limit the consequences of any bad decisions that they made. So in many ways, the United States system was at this point moving into the ultimate in crony capitalism. This was the American safety net as seen by one cynical commentator, taxpayers providing safety net for financial institutions that had become too big to fail. And of course, when the 2008 crisis hit, it was in fact the federal government that stepped in to bail out Bear Stearns, Morgan Stanley, et cetera, and it was the taxpayers who basically were left holding the bag. So fundamentally, we had in this 2008-9 crisis an economic problem that again was created by a political development model, in this case the US or the British or the Irish or the Icelandic financial model, namely depending heavily on finance as a big chunk of the nation's GDP, but undercut by the excessively important power of finance and the belief in this self-regulating financial market, which in fact never moved into place, never became self-regulated. So you have those two crises, and the last point that I want to raise is whether the second of these crises, the most recent one in which we now find ourselves, or which the Americans now find themselves, you folks are spared, is in fact a global crisis which has escaped capturing East Asia. As I said earlier, the crisis was initially transmitted to Asian economies through the decline of global exports. Asian exported goods were no longer as easily able to be sold in Western Europe or the United States, but because the countries as a whole, the G20, agreed to stimulative measures for their economies and did not move toward protection, Asia was able to rejoin or catch up to its export orientation and to return to relatively high growth. And I think there were three things that really insulated Asia from the current crisis. The first of these is that Asia has remained focused on the real economy, by which I mean it has avoided getting too heavily involved in financial derivative products and sophisticated or dangerous or risky financial instruments. Secondly, a great deal of intra-regional dependence, both in trade and finance. And finally, some important structural shifts in the period after 97 and 98. As Ambassador Desker said, Asia learned a lot of lessons as a result of the crisis and took a number of steps to insulate themselves. I'm just going to take you briefly through a couple of these points, but the growth rates in Northeast Asia recovered quickly after the crisis. Those in Southeast Asia did much the same. Indonesia's all over the map with quarterly results that were as high as 40% for one quarter. But basically, the fundamental point is 10% or 7 or 8% growth through much of Asia into 2010. And it seems to me this is the result of focusing on what you might think of as the real economy. Manufacturing, exports, infrastructure development, fostering the middle class, long-term economic growth. And one way to think about this is that the share of financial institutions and domestic bank assets in Asia was far below that of the globe as a whole. It was 23% globally, big finance important globally, and Asia was only at 6%. So your banks, your financial institutions have played a much less significant role in your overall economic growth than they did in the United States and Western Europe. So quite obviously, less vulnerability to a financial crisis. Trade as a percent of GDP, again, figures you're probably familiar with, but WACO figures of 300 and 400% for a couple of the smaller economies, the entrepôts of Singapore and Hong Kong, for example, but 100 to 200% of the GDP of many countries are really resulting from trade. Importantly, too, Asia has become increasingly regionalized in its trade and investment. More and more of East Asia's goods are involved in what you might think of as regional production chains or value chains, goods that start out as timber in Indonesia and move as logs to China, are milled in China, sent to Vietnam for creation of furniture, are then painted in Vietnam, but sent off to Korea for cushions or polishing or whatever, and eventually sold elsewhere. Multiple chains of interaction for goods and services across East Asia, with China replacing the United States as the #1 destination for the exports of virtually all Asian countries in their exports. In addition, following in the wake of the financial crisis 97-98, Asian governments took a lot of steps collectively to multilateralize their financial activities. I'm sure many of you are familiar with the Chiang Mai Initiative, a series of bilateral currency swaps. It's now become internationalized as the Chiang Mai Initiative multilateralization. Somewhere in the neighborhood of $240 billion. All of the countries involved are committed to avoiding any kind of liquidity crisis that might replicate what happened in 97-98. Asian bond markets have been put in place, and many best practices in finance have been adopted by shared experiences. So despite all of the security tensions and difficulties that separate Asian countries, there is also a great deal of cooperation going forward on trade and on finance that make these countries much less vulnerable on things outside except through the trade window. Finally, on lessons from 97-98, financial reforms put in place. So lots of increases in the foreign reserves of most countries. As I'm sure all of you know, the foreign reserves, China, Taiwan, Japan, South Korea, all went up astronomically. Even countries like Vietnam doubled or so their foreign reserves. Tougher financial firewalls to buffer them from international challenges, more regulation at home, no sense that government should get out of the business of overseeing companies, overseeing finance, but in fact just the opposite, greater government regulations. And importantly, as I've said on more than one occasion, Asia tended to stay away from the most heavily speculative financial products. Basically, they stayed on the sidelines as the US, Iceland, Ireland, Britain, etc., moved ever more into these sophisticated instruments. And as one financial analyst told me in Asia, it wasn't that we didn't want to do these things, but we just didn't understand them. So we were staying as far away from them as we could, which probably was the best advice possible. If the financial instrument is 320 pages long, it's been created by a theoretical mathematician, chances are you, me, and most of the folks in the room are not going to understand it, and chances are it may be a little bit dangerous. So East Asia plugged into the global economy, but with a lot of surge protectors to prevent the kind of crisis that had taken place in 97, 98. This is a not terribly well focused, I'm afraid, indicator of the share of the financial sector in GDP of 5 of the major countries, the US, Japan, etc. I, for better or worse, circled the Japan case, which shows how much lower it was than the United States, Britain, etc. So Japan was not playing in this game. I've also highlighted the vulnerability for the United States to subprime losses. It was, in absolute dollars, 157 billion by one count, 10% of capital, and share of assets much higher than it was in Asia. You see the numbers in Asia much, much lower. So the long and the short of it was, Asia came out of this crisis reasonably well, in part because it wasn't playing the same kind of risky casino capital games that were being played in the United States, Britain, and other countries. The last point that I simply want to raise, lest there be a mood of euphoria across Asia as a result of having escaped what seems to have engulfed the United States and Western Europe, many are asking whether Asia is now poised for a second miracle. The first miracle was the one that was captured by the World Bank in its study about the about the Asian financial miracle. So it's tempting to ask if Asia can return to the high growth rates that it enjoyed before the East Asia crisis, or that it's enjoying now in the wake of European and American stagnation, and will Europe take the lead? Lots of assets from Asia that come to the table, but I think it's important to recognize that China's growth is by no means guaranteed. Everybody's now seeming to get rich writing a book about where and how China will stumble, and we see China's growth rate falling from 10% to 8%, and everybody is biting their fingernails. But there are lots of problems in China, no guarantees that growth will continue. Many countries in Southeast Asia that have been very good at export success through labor-intensive production face the difficulty of how to get out of what many would call the middle-income trap. You know, we're good at labor-intensive stuff, but are we ever going to create stuff that's going to move us to the next level? Can Vietnam become Denmark? And can Malaysia become the equivalent of Ireland or Belgium or Holland or whatever? It's not clear. Japan, despite Abenomics, which I understand you all had the benefit of hearing about from the horse's mouth last week, there's no guarantee that Japan is going to resurrect its economy. It's still got major hurdles to overcome. So I think the prospects for Asia look to be very good, but the problems should not be ignored, and I think it would probably be a mistake to enter into a mood of unsolicited euphoria, because that may in fact be the biggest danger that might impede Asia's future moves ahead economically. So a couple of quick conclusions to offer before I open things up for comments and questions. Despite clear economic manifestations, I think the politics of both these crises have to be understood, because they give you a handle on how complicated things like domestic strategies of economic development intersect with the power of global capital in ways that can be positive but can also be dangerously negative. And so far, the Asian governments have managed to escape surrendering their regulatory controls over finance and their regulatory controls over the national economy in favor of anything like a Washington consensus. A regulatory government seems to be pervasive across most of East Asia. And then finally, the areas of Asia have essentially insulated themselves far better now than they did in 97, 98 from the power of global capital, and it has allowed them to continue their own politically oriented growth models without necessarily becoming excessively dependent on the outside world for finance. And I think there's been a great deal of skepticism about global finance and becoming excessively dependent on it, and relying much more heavily on Asian-based models of development and growth. Let me stop on that note and open things up for comments or reactions or criticisms. Thanks very much.